Hi, we're going to run through question 5. It's on page 79 of the manual, and we're going to do a statement of profit and loss and a statement of financial position for a sole trader. So it's a basic example. Every question you get, there'll be a trial balance. There'll be some closing inventory underneath at the end, which we'll have to adjust for. It's the first adjustment we're going to see. And then once you identify the expenses, the assets, etc., liabilities, you can prepare the statements. So the first thing to do is go down through the page and identify what's an expense, what's an asset, what's a liability. So we run down through it, and I have it here on the next page. I've gone down. So I really should have called these cost of sale expenses. So anything to do with purchases is a cost of sale expense, but it's an expense that reduces our profit. So our profit and loss account is basically our sales less our expenses. So purchases is a cost of sale. Opening inventory is added to purchases. It increases our purchases. Delivery cost to customers is a selling expense. A normal expense delivery cost of purchases increases our purchase cost. Sales returns and purchase returns reduce sales and purchases respectively. And then we have these expenses here. And then the first assets we see are here. Motor vehicles and fittings are the long-term assets. They're going to be there about a year later. Whereas cash at bank and cash in hand is going to, that could change in the near future. Equity and drawings reduces our capital. And then we've one asset, receivables, known as debtors, a short-term asset, a current asset, and then we've a liability, payables, suppliers we owe money to, who are short-term liabilities or current liabilities. And our adjustment, we're told closing inventory is 4998, so at the end of the year we had stock or inventory worth that much. That's a current asset. And also it reduces our purchases, because we're going to sell it in the next period, so we shouldn't include it in this year's or this period's purchases. So I'm going to show you sales less all the expenses together, and you can see the profit, and then we'll have to adjust that to make it look a bit better. So here is our profit and loss account, or income statement. I should have called it profit and loss account. And there's our sales, less our sales returns, and then all the expense items that we met. And all I've done is grouped anything to do with purchases together here. Opening inventory, delivery costs of purchases gets reduced by purchase returns and gets reduced by inventory. But basically, if you had your sales less your sales returns, less all of your expenses, and all our expenses here added together sum to 15,428. So sales less sales returns less all of these gives you a net profit of 2732. So that's really what a profit and loss account is, or income statement. It's your sales reduced by any sales returns and reduced for all the expenses. But the only thing we have to do is, I've called them cost of sales, or COS. Just group these together and get and I'll show you what that looks like on the next page. So you start off with your sales less sales returns, and then the 5 cost of sales items, which are all the purchase expenses, are grouped together. We get a total, and that gets reduced our sales. Our 5 expenses that are left are grouped together, they're totaled, but you still end up with the same profit of 2732, which we had over here. So this was a simplified profit and loss. I'm going to change that. But the proper profit and loss account has the cost of sales items grouped together in a subtotal for them. So basically all we're missing here is a subtotal for these. If we look at it, these add up to 10213, and these add up to 5215. So there's our cost of sales. So that's what your profit or loss account or statement should look like. And then profit is that. The second statement we're asked to prepare is the statement of financial position, which is where you list your assets, your equity, and your liabilities. And the total of the assets should equal the total of the equity and liabilities added together. So when we look at our trial balance here, we have 1, 2, 3, 4 assets, 5 is receivables, and 6 is closing inventory. So there are assets. Our equity is the investment by the owner in the business, so capital, money invested at the start. Drawings reduces equity, reduces capital, so we'll have, in equity we'll have capital, 12,844 minus 2,050, plus any profit that we calculated in the statement of profit and loss. And then liabilities get added to equity, and we've only one liability, which is payables. And a simplified statement of financial position is here. All our assets, 1, 2, 3, 4, 5, 6 assets, and the amounts from the trial balance, which we just got from here. Motor vehicles 24, fittings 600, cash at bank 3876. So we just list them down, and the total of all these adds to 16,571. Now, in a second I'm just going to divide them up between non-current and current, but we'll ignore that for now. The equity always has 3 items in it: capital less drawings plus retained earnings. And the retained earnings we get from the bottom of the profit and loss account. So if we come up here, we calculated our profit was 2732. That's what appears down here for retained earnings. And if there was any retained earnings brought forward, we'd add this year's profit to the ones brought forward that would be in the trial balance. And any liabilities, which are only 1, and these items added together total 16,571, and that's when you know your balance sheet is right. It's a good indication it's right when your total of your equity and your liabilities, which is this figure, equals the total assets. And the only thing that's left to do is divide the assets between long-term, so resources that are going to be there for at least a year from the end of the balance sheet date. So the year end is April 16. Would you expect your motor vehicles and your fittings to last longer than a year? And you would. So they get divided up into non-current assets, and the current assets are the other assets, which are, you don't expect to stay the same for a year. And that's the only difference. Non-current assets are just shown like that. Current assets, short-term assets that are going to change, all these things change in the short term. You'd expect your customers to pay you, hopefully in less than a year. And so that's total is still the same. And equity and liabilities, just a subtotal, same as the expenses above, and adds up. And that's it. Thanks for listening.